economic data. Jim Bianco of Bianco Research writing the Fed should not continue to cut rates. The economy is doing much better than the consensus. Jim joins us now for more. Jim, welcome to the programme, sir. I want your perspective first on the recent Fed debate, the division that we're seeing from the Fed speak of the last week or so. Where do you land on things, Jim?
I think some of that is political. I think some of the Federal Reserve officials are running to try and replace Jay Powell. And I might respectfully say that the quote you had from Jim Bullard is in that camp, too, because it was very inconsistent what he said. And I think some of it is genuine, that there is some that are looking at the economy kind of like I do. And that is that it's doing OK, if not better. The Atlanta Fed GDP number is now nearly 4%. It's higher than every single estimate on Wall Street right now. And the inflation data is staying sticky. And the goods part of data, which would be tariffs, is really starting to show signs that it's moving higher. So for those that say, where's the tariff inflation? It's right there. It's coming. It's underway in the CPI goods category.
Jim, how credible do you think this pursuit of 2% is? It's something that dominated our conversation on decision day. Is this credible?
It's got a problem. And the reason it's got a problem is if you look at the inflation expectations data, I'm talking about like the inflation swaps or the CPI break-even rates, or the TIPS, break-even rates. They're all above 2.5% out till 2030. Well, I know, one of the best questions I heard during the press conference was from Mike McKee, where he pointed out that the Fed said, we'll be at our target in 2 years. And he pointed out the last 11 years, you've said you'll be at your target in 2 years, and you've yet to be at your target in 2 years for 11 straight years, and now you're going to try for a 12th year. And the market is saying you're not going to beat your target for 5 more years, because out to 2030, it's still got, elevated inflation. Not runaway, but definitely not getting anywhere near 2%. And the Fed needs to address that. And they're really not at this point.
At the same time, Jim, can't you say that tacitly, if they're accepting 2.4%, which is currently what break-even rates are pointing out for the next 10 years, is the likely inflation rate? If that is the inflation rate, isn't this market and isn't this Fed saying that's fine, as long as we don't torpedo the labor market, as long as we keep the economy chugging? Where's the problem?
The problem comes in where's the neutral rate. If you're going to accept 2.5% or so as the inflation rate with R-star, that's 3.5%. If you're going to, that would be a 1% premium above that. If you're going to accept 2.5% as inflation, maybe R-star should be a little bit bigger. In other words, you're no longer moderately, you're easy in the market. You're probably at neutral. And if you cut 1 or 2 more times this year, you're going to be too easy in the market, and you're going to risk fostering more inflation. So it really comes down to, do you want to cut rates 2 more times? If you do, then you shouldn't be tacitly accepting 2.5% as the inflation rate, long-term inflation rate, because you should be done cutting rates then at this point.
Do you get comfort, Jim, from the fact that after the Fed cut rates, you aren't seeing a steepening of the yield curve? You aren't seeing a runaway at the long end of the yield curve like what we saw last year, that people are seeing there as justification economically for the Fed to be more aggressive?
Yeah, at least at this point, but I fear that we're in a holding pattern waiting for more data. And I also fear we're not going to get that data because we're going to have a government shutdown on Wednesday at midnight. And I'm talking about like the payroll report on Friday, and next week, the CPI report. Remember that the last government shutdown under Trump in 2018, 2019 lasted 35 days. And the Fed is effectively going to go into the October 29th meeting with no more government data, which is what they rely on, Jay Powell called it the gold standard, than they have today. And they'll just assume that everything is as they understand it today, and they'll cut rates. And what I'm afraid of is when we get that data, whenever we get that data, it's going to show a meaningful uptick in the economy.
Jim, I want to build on that. We've been talking about this reacceleration now for a while. Market's priced for it into 26. Lisa mentioned nil data early this morning. This is what he said on the jobs market. If firms expect growth to perk up, it's curious they haven't ramped up hiring an hours already, Jim. What do you say back to that?
I think the issue with the labor market is really the break-even rate right now. We need to start ask the other side of the question, which nobody wants to touch. Okay, we've created 29,000 jobs over the last 3 months. How many should we be creating? And Jay Powell answered that towards the end of his press conference. He said maybe 0 to 50,000. Midpoint of that's 25,000. We've created 29,000. I understand this is a number that we're not used to. To say 29,000 jobs over 3 months is just fine. That's all we need in this economy. but we've got the lowest population growth in almost 100 years because of the closing of the border and increased deportations. And if that's the case, if you have no population growth, you don't need to create that many jobs. So really, this is the crux of the labor market issue. It's not how many manufacturing jobs versus service jobs versus healthcare jobs did we create last month. The fundamental question is, how many do we need? And the answer might be not that many, given low population growth.
Jim, thoughtful stuff. As always, Jim Bianco of Bianco Research. We've heard this a few times. You've had to step down.